finding a way forward through the Red Sea, at Davos, in the presidential campaigns, and once again in Congress. This is Bloomberg Wall Street Week. I'm David Weston. This week's special contributor Larry Summers of Harvard on the fiscal path ahead for the U.S. government.
Our fiscal problems are much more serious than they were in 1991 or 1993.
Afsaneh Beschloss of RockCreek on plotting a new course for ESG investing.
The economics of solar and wind have changed. Today, they are very economic.
And Blair Effron of Centerview Partners on getting mergers and acquisitions back on track.
M&A feels like it'll be much more important for them in 24 than it was in 2023.
Global Wall Street spent the week looking at some hard problems and searching for some solutions as attacks from Houthi rebels on commercial shipping in the Red Sea worsened despite U.S. and British military action.
I don't think it was possible to go on allowing these attacks to continue in the Red Sea.
In Davos, the great and the good gathered for their annual meetings, which this year focused on the newest bright and shiny object, generative AI.
It's not yet like replacing jobs in the way or to the degree that people thought it was going to.
What we're doing is we're addressing some of the most profound social challenges with AI in ways that are transformative.
Even as Secretary of State Blinken had trouble getting out of town because his plane broke down, only adding to Boeing's problems. In the frozen tundra of Iowa, former President Trump found his way forward with a resounding victory in the caucuses there.
The important thing is for us to just take the victory tonight and send a message to the nation, the world, that the Republican Party is going to be supporting once again Donald J. Trump for the presidency.
And back in Washington, Congress continued to struggle to come up with some set of compromises to avoid a government shutdown.
Congress has been able to keep the government open only by kind of kicking the can down the road.
Whatever the struggles the rest of us may have had this week, the markets certainly had no trouble finding their way as the S&P 500 closed at a record high for the first time in 2 years, up almost 1.2% on the shortened trading week. That put it at 4839, which is only about 100 points below the median number the Bloomberg L's have for the S&P to close at the end of the entire year. The Nasdaq was up as well by 2.26%, while the yield on the 10-year marched back up above 4%, adding almost 20 basis points to end the week at 4.13. Here to take us through the record-breaking week, we welcome back Peter Borish. He's chairman and CEO of Computer Trading Corporation. Peter, thank you so much for being here.
With pleasure.
Pick the right week, record week in the S&P. What do you make of what we saw this week in the equity markets?
Well, the week itself was a bit fascinating, just if you listen to your preview there. So everybody loves higher markets. And this was incredible week, right? Shortened week, holiday week. At the same time, you had global uncertainty, which was just mentioned. Maybe there was optimism because of the fiscal deal, as your person just said, to kick the can down the road. But the fact that interest rates are higher, faster than people expected, is something that you need to watch. I've never seen so many people prepare for interest rate cuts and then keep pushing out the forecast. So I guess if you're going to forecast often.
So one of the things that you are so astute at is really understanding the way the markets work. Is that the thing that's driving it right now? Is it that an anticipation of cuts from the Federal Reserve? And are the markets getting a little ahead of themselves, even though they came off a little bit this week?
So yes, there's this expectation that the Fed itself is trying to tamper, in the sense that all the public statements this week are, hey, we're not going to cut as soon as you think. The March futures markets have really cut the probability of a cut then in half. It's highly unlikely in an election year to see the Fed cut so many times. Historically, that has just not happened.
Well, I was wondering about that historically, because you have that historical perspective. Does the Fed have to be a little concerned, particularly as we get into the year, that if they start cutting a lot, it looks like they've got their thumb on the scale of the election?
So that's going to be a problem, because every point that takes place then becomes a question of, are you favoring one candidate over the other? So if they cut, Trump's going to say, oh boy, you're just doing it to support Biden. If they don't do anything, then the Biden camp may say, well, you're doing this just to support Trump. It's a very no-win situation. But you have to look at the economic data. Someone tell me why the Fed needs to cut. Equity prices are at record highs. That's a good thing. Crude oil, given all the uncertainty in the Middle East, is still in the middle of its range. Unemployment is low. We just had a number yesterday on initial unemployment claims that was the lowest in decades. If I'm sitting at the Fed, that's a pretty good thing. Why do I have to do something?
So what's an investor to do in that world?
Be thankful. Right? So you want to have a diversified, sort of portfolio. This is not an opportunity, I don't think, to try to buy losers. What we've seen is that what's going up has continued to go up. That often happens when you've had a strong year and you have an overthrust into the new year. Historically, the biggest turning point has been in March. And so I think we're going to see strength into that March expiration, just sort of to pick a date, and then we're going to have a better sense, because that's the same time that the next continuing resolution runs out. You happen to have what that month? Oh, the Fed meeting. So what if they come out and say, no, we're not going to cut? So right now it's pretty clear ceiling as far as the equity market goes. 6 weeks from now it might be a little different.
Equities, does that mean you go into bonds?
Yes. I think bonds are a win-win. You're getting a good yield, and if the Fed happens to cut, then you're going to get some price appreciation. Not too often you have that double opportunity.
Does that mean you come out of cash? Because there's an awful lot of money right now out there in the money market funds.
I would. Think about it. Even if you're uncertain here, the 3-month until after the next Fed meeting is over 5%.
Yeah. And that's real money.
Yes, it compounds nicely.
Consider what we've had. Peter, it's always great to have you with us. That's Peter Borish of Computer Trading. Coming up, guns, butter, and the deficit. We ask our special contributor Larry Summers of Harvard about the hard choices we face. That's next on Wall Street Week on Bloomberg.
I don't think the U.S. has lost that vibrancy. We're going to regain it in the second half of this decade. The second half of this decade, one of the overriding issues facing the economy and the political decision makers will be the infrastructure of the United States, to rehabilitate our educational facilities, to rehabilitate our roads, our communications, our environment.
I think the solution to the budget deficit problem is really twofold. Number one, create strong, sustainable economic growth by, as you said, getting out of the way of the private sector, support entrepreneurship, investment incentives, and so forth. Number two, we've got to restrain federal spending, and I think on this point there's a lot more work to be done.
That was Henry Kaufman on Wall Street Week back in 1991, and Larry Kudlow appearing with Louis Rukeyser in 1993, taking decidedly different views on spending and the role of government. For his thoughts on where we should be heading in 2024, we welcome now our very special contributor, Larry Summers of Harvard. So, Larry, welcome back. Great to have you here. We've talked about some aspects of this before. I mean, I could say it's guns, butter, and deficit. The question of defense spending, the question of investing in future productivity, the question of deficit. If you were the architect once again of U.S. fiscal policy over the longer term, where should we be heading?
Let's start with the recognition that our fiscal problems are much more serious than they were in 1991 or 1993. Then we had budget debts relative to GDP in the 30% range, with out-year deficits perhaps in the 5% range on honest forecasts. Today we have a debt-to-GDP ratio above 100%, with out-year debts in the 10% of GDP range. So we've got a much more serious problem, number one. Number two, then we were reaping a Cold War dividend from the end of the Cold War, and we could reasonably expect defense spending as a share of GDP to be falling. Today, though it's not reflected in the CBO forecast, almost certainly we are going to have to substantially increase defense spending and spending on a broader range of what, in a sense, are international security activities. Issues like global health, issues like resilience, most importantly, climate change. So we've got a very different kind of problem. There are places where we're going to need to cut government spending. We need to control cost growth in healthcare, but we've already controlled it substantially over the next decade, and I suspect the challenge is going to be to maintain our momentum, not lose that momentum, and it's going to be very difficult to get even more momentum out of healthcare costs.
So, Larry, you were there in the Clinton administration when there was the tax increase from the Clinton administration that got through politically. It's never popular to increase taxes. Now, what effect did that have on productivity, and to what extent was that masked by the internet coming online that really increased productivity? So one of the questions people ask is, if you increase taxes, are you going to reduce productivity?
No. First of all, the last time we did it, in 1993, productivity soared afterwards. When we had much higher tax rates in the United States in the 50s, the 60s, and the early 70s, productivity growth was more rapid than it has been in recent years. The vast majority of the funds that flow into venture capital come from institutions like state pension funds, university endowments that are tax-free investments. It defies belief that the young Bill Gates, the young Mark Zuckerberg, the young Steve Jobs would have not done their projects if they thought they would have had to pay a bit higher capital gains taxes, and we would have been without those companies.
Larry, we have our set of challenges in the United States economically. What about China, the second largest economy in the world? I know you've just gotten back from China. They reported GDP numbers that were encouraging, better than they thought. Some people question those. At the same time, the demographic numbers were bad. They've got a real problem with foreign direct investment. What did you learn from your China trip?
I came away as I went with substantial concerns about China's growth prospects. They have so much savings, so much money that in a normal country would be flowing into household consumption. In the United States, household consumption is 70% of GDP. In Japan or Korea, in their glory years, it was something like the high 50s or 60% of GDP. In China, it's in the high 30s. So they have this huge foregoing of consumption. And then the question is, where's all that money going to go? And for a while, it went into exports and trying to get demand, but the rest of the world isn't going to tolerate huge increases in China's exports. For a while, it went into real estate, but they've got vast acres, not acres, called square kilometers of empty, half-finished apartment buildings because of overbuilding. For a while, it went into infrastructure, but they told me about, for example, one of the most remote provinces in China that has, 20 of the world's top 100 highest, longest suspension bridges. And, that's just a kind of wasteful overinvestment. And when you have wasteful overinvestment, not long after, you have bad debt. And when you have lack of demand, you start having deflation. And when you have deflation and you have debt, the debt gets more burdensome and the whole thing cycles. That's basically why Japan had a very weak generation of economic growth after 1990, and China is facing similar kinds of challenges. And never count the Chinese out.
And finally, Larry, give us your thoughts on one specific transaction. We have Nippon Steel seeking to buy U.S. Steel. We've heard from regulatory authorities it's going to take a good long time. They have some concerns about it.
This is a test for the Biden administration. Has their commitment to resilience and industrial policy been a serious commitment based on a desire to strengthen and make more resilient the economy? Or is it a cloak for protectionist pandering to traditional industries with no genuine national security rationale? There is no remotely plausible national security rationale for questioning the Nippon U.S. Steel transaction. Japan is a staunch ally. The production will continue to take place in the United States. The result will be the infusion of more capital into the U.S. steel industry. The result will be lower priced steel as an input when 100 times as many U.S. workers are in industries that use steel as are in the steel industry itself. So this should be a layup for policymakers who have the right motivations. And if it's not, it is a sign of very troubling economic nationalism on the part of the United States.
Okay, Larry, thank you so much for being back with us again this week. That is Larry Summers, our very special contributor here on Wall Street Week. Coming up, what corporate leaders should be thinking about as we move toward the November elections in the United States. We'll ask Blair Effron of Centerview Partners.
I think it's important to either candidate that we rein in our deficit.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. As we move toward the U.S. presidential election in November, Wall Street Week will be taking a look at what the outcome could mean for business and the economy. We're going to be calling it Wall Street Votes. And this week, we welcome Blair Effron. He's co-founder of Centerview Partners. Blair, great to have you back. Thank you for joining us.
David, thanks for having me.
You spent a lot of time with Wall Street writ large, CEOs, people who really are influential in the business community. As you look forward to the election, and let's assume for the moment, it's an assumption, not a clear truth, but an assumption that it is, once again, Donald Trump against Joe Biden. From what we know of their policies, what should Wall Street be looking at in that sort of choice?
For the first time in history, we have two candidates that have been president, so you have a track record of what to expect. In the case of President Biden, you've had so far 3 years of steadiness, good growth, markets at an all-time high. I think it's underappreciated what has gone on with the economy. Unemployment at 3.7% versus the Trump years at 4%. Job creation, if you take out COVID as the impact, you still have 9 million jobs created under President Biden versus 6 million under President Trump. And even GDP growth, a few basis points higher under President Biden. So in addition to that, you've had a re-engagement globally. And when you think about our biggest and best companies, 60% of their business is outside the country, outside the U.S. Therefore, having an important, steady relationship with allies and adversaries, where you're protecting U.S. interests, but also looking out for the interests of corporate America, I think does matter. And I think if you look at the policies ahead, what do you expect in a second term? I think with Joe Biden, you still have out of the $3 trillion of investment spend, there's $5 trillion of total spend, but only $3 trillion towards investment, infrastructure, CHIPS Act, IRA. 75% of that is still available to be spent. So you will get that spent. You'll have $900 billion has already been spent by the private sector, capital, in terms of support behind IRA. For example, carbon sequestration facility by Exxon down in the Gulf Coast, everything in Ohio around chips. You'll see more of that. I also think you will see policies aimed towards lowering costs for all Americans. You saw in the first term, drug pricing, insulin. In the second term, expect more around child care, long-term care benefits, more around drug pricing, and continued engagement globally. So then the question is, with the Trump presidency, what do we know so far?
Well, what about that? Because if you look back, I think a lot of Wall Street says it was not a bad time under President Trump. In fact, we actually had good growth. We had good job creation, less regulation, less taxation. A lot of companies did pretty well, didn't they?
The companies did well, and they continue to do well. And I think that people need to appreciate that our private sector is as innovative and vibrant as ever. But even in this regulatory question, everybody talks about my world, M&A. Fact is, for the first 3 years of President Biden versus 3 years of President Trump, M&A is up 6%. In terms of policy, what we've heard so far, the thing that I'm particularly focused on is the notion of tariffs, 10% tariff across the board. And that, to me, is a tax on Americans. That's $300 billion of increased cost to Americans. That's inflationary. It's estimates you've seen by independent analysts have 500,000 jobs at risk, and probably a point or so less GDP growth. So that's concerning. And in addition to that, the question of budgets. I think it's important to either candidate that we rein in our deficit, and if we let the tax cuts put through under the Trump administration continue, that's another $3.5 trillion to the deficit. And I think it's very important in this environment to do that. One more thing I'd point out, we've had a high interest rate environment. And the fact that we are still able to have a tailwind for the economy is a testament to the innovation and talent of our companies, both small business, which is half of our economy, and the most important, biggest companies on the other side of the spectrum. So under Trump, we had basically free money, and I think it's added a certain discipline. So when we talk about growth, it's actually even more impressive that you can grow in the current environment.
You mentioned the debt and deficits. How concerned is the C-suite, sort of generalizing here, but how concerned is the C-suite about debt and deficit? Because when you talk about the tariff issues, there are clearly issues about how we would conduct ourselves in the world. At the same time, even the Committee for Responsible Federal Budget says that, in fact, it would reduce the deficit because it would be money coming to the coffers of the U.S. government.
So, first of all, the deficit is as important an issue as everybody thinks it is. You never know when it hits you. It's either cancer or it's a heart attack, and at some point we will be reacting to it. I would tell you that no matter who is president, that must be dealt with. In the case of President Biden, obviously the IRA, there's a reason Inflation Reduction Act has a deficit component in there, bring down deficit $300 billion. And I do think that the strength of this country depends on the strength of the dollar, depends on capital inflows, depends on the sanctity of our budgetary process, and that all says we need to be focused on the debt before it starts focusing on us.
Blair Effron will be staying with us as we turn to mergers and acquisitions, and when we'll see that pipeline start to produce some real results. That's coming up next on Wall Street Week on Bloomberg. Corporate transactions have hit a dry spell. After a blockbuster year in 2021, mergers and acquisitions stalled in 2023, though by the summer, bankers like Evercore's Ralph Schlosstein were hoping for more action in the second half of the year.
Announced M&A for the first 6 months of the year was down, the dollar volume was down 40%. I don't expect it will be quite as bad in the second half of the year, but certainly the amount of dialogue among our clients is up quite dramatically, and our backlogs are up.
And there were some areas where things did pick up. like on international deals.
This year was very busy for us on cross-border M&A. So we're seeing companies listed outside the U.S. just migrate to another new listing here and turning it into their primary listing, getting a multiple bump. But we could also just see a lot of U.S. companies spending their cash overseas.
And as we get into 2024, there's reason to believe there's the appetite out there, whether it's from private credit.
If you look at the likely demand for private credit, if you take the $2.4 trillion of dry powder in private equity funds, and you assume $5+ billion of deals, there's an enormous demand for private credit.
Or in tech, where valuations may be making deals more compelling.
I do think investors have more confidence in the levels that we're at from a valuation standpoint more broadly in technology, and are starting to see the competing tension in the public market of M&A from strategic, take privates, for example, or from take privates or from strategic activity leading into the end of this year.
But when you talk with the bank leading the league tables in M&A, Goldman Sachs, there remains a big difference between the interest and appetite and the deals making it over the finish line.
When you think about what really drives the future M&A, we think there's a lot of pent-up demand. The pipeline of dialogue is as robust as we have seen. What the challenge has been is just getting the fingers to meet on transactions.
And to take us through where we are in mergers and acquisitions right now, Blair Effron, co-founder of Centerview Partners, has stayed with us. So Blair, this is really what you do for a living. We've talked a lot about the fact that mergers and acquisitions were way up, came way down, and then we've talked about a pipeline. You've talked about in this program, pipeline coming. It's been coming for a while now. When is it actually going to get here?
So great question. Obviously, you're an investment banker. You're pretty naturally optimistic. So we always think that things will be better. I would tell you this. We do see the shoots. And actually, it's already happening. In January, for example, if you think about larger transactions, we've already had 4 transactions in the first 2 weeks, over $10 billion. You compare that to last year's entire first quarter, there was 5 transactions over $10 billion. So it is happening, 1. 2, the fact is there's an optimism in the C-suite that we have avoided a significant downturn, and in fact that will have a tailwind and some growth, and that's always a good environment in which to do M&A, and we're getting a sense of that strongly. 3, there's a pent-up demand. We haven't had an important M&A in 18 months. Last year was a $3 trillion market. That compares to an average the 5 years before that, $4 to $4.5 trillion. So there is this demand, David. And remember, companies are actually really good at thinking about inorganic activity, M&A activity, in a way that 20 years ago wouldn't have been the case. So it's such a core part of what they do that there's a little bit of makeup. And then you think about the financing markets. There's more liquidity. Not perfect, but more. And what we see on financing, for example, on leverage deals, at this point you can get 5 to 5.5 times leverage. If you go back 6 months ago, it would have been in the 4s. So there's a lot of reason to think it is a good time. And the last thing I'd say is we're in an election year. And the dirty little secret is 20 out of the past 24 presidential elections, markets have done well and gone up in the last year.
Let's talk about the financing for a second. There are some people, particularly in private equity, who are saying if in fact the Fed cuts earlier rather than later, that will really stimulate mergers and acquisitions. Is that your experience? I mean, is it important whether they cut in March or they cut in July, and is it important how much they cut this year?
I'm not in that camp. I'm in the camp that wherever we end up at the end of the year, in terms of the rates, has been priced in. Whether it happens in March or happens in May, will have limited impact on my world. The trend will have a positive impact. The fact is, when rates get cut from the first rate cut to the final rate cut, if you look at the past 5 times this happened, markets have done very well. Okay, so, and that's what will be priced in. I think the bigger question is going to be valuation, number 1. After you've had such a run in the market, you have the obvious question, am I buying it at the XYZ company at the right time or not? And the way you think through that, and how long will the process take from a signing to a close? That actually continues to be a big factor, as it should. So I think that as we find a level in the markets and things continue to settle out, it encourages both the buyer and the seller to say, okay, there's something that can be done here. But in general, I just back up and say the conversations that I'm having and my firm's having with senior leaders across different industries suggest that M&A feels like it'll be much more important for them in 24 than it was in 2023.
So in financial media, which doesn't necessarily make it so, but in financial media there's a lot of talk about private equity and having a lot of portfolio companies, the need for private equity to actually get some money into the hands of some of the people who have given their money. Is that an impetus right now to have more transactions done?
I think private equity will be a very strong driver in 2024. If you think about the years preceding 2023, it was basically 40% of the market. There is such a large group of companies that are looking for liquidity and coming from private equity that I do think it'll be a very active time. And again, that goes directly to the financing markets as well. The financing arena will be more liquid than it was last year. And we're seeing most of the private equity world think about being more active. And frankly, to their credit, they slowed down activity at a moment when they should. Last year it was much easier for a corporate to look at something and not think they had private equity competition. This year, when we see companies we're selling, the interest is both corporate, we're already saying it, corporate and private equity.
How much of your business in merger and acquisition is driven by essentially the need to reform parts of a sector? I mean, I'm thinking of one that I come out of media right now. There's a lot of pressure right now for some of the big media companies to really think about the cards they've got and how they deal with them and how they get rid of some, how they pick some up. How much of M&A is really driven by these big companies saying, you know, we got to really restructure?
Today, I think it's most of it. Progress, transformation is happening so quickly and is so disruptive that every company is saying, here's my portfolio today, but where's it going to be tomorrow? So even when you talk about your world, media, it used to be traditional media with 3 networks. Now it's traditional and non-traditional players. Apple, Google, Amazon are as active as Disney, Comcast, Paramount. Gaming, what is technology? It all becomes one industry. If I go across any industry, that is what we see. I look at the pharma world. The fact is, life sciences is one of the biggest areas out there. Why? Because we have such innovation going on in this country. So many companies you never heard of 5 years ago and never heard of that have become really important just 5 years later, that this becomes a window when you think about R&D for a big pharma company. It's more interesting in many ways to buy than build. So I would say that every business is being challenged in ways it never was before, and it's causing CEOs, it's causing boards, it's causing seasoned leaders to constantly rethink their ideal portfolio, recognizing there is never an end state portfolio anymore. It is always going to be evolving. And the good news is we have as talented and experienced a group of leaders as ever. So when a CEO undertakes M&A today, chances are strong that he or she is going to end up doing a good job and the right thing for the company, both strategically and financially.
All of which supports your view that 2024 looks like it'll be a lot stronger than 2023 in mergers and acquisitions. What does that say for Centerview Partners? Are you hiring? And if you are hiring, what sorts of people you're hiring? Because it looks very different than it did certainly 10 years ago, maybe 5 years ago, because of some innovation, not to speak of, for example, generative AI.
Boy, that's a great question. First of all, we are hiring, so anybody has a resume, let us know. We're always hiring. The skill set we look for is probably different than you would think. We want people who can think critically, who can analyze situations, who have judgment, have an ability to make difficult problems distilled into more simple problems. And it's less about whether you can make a great model. I do think when AI, over time, will replace some of the skill sets that we see traditionally done in STEM, coding, for example. I'm not sure that if I was, I'd be advising my kids that learning how to be great coders is going to matter in 10 years. What will matter is, do you have judgment? Do you have an ability to think critically, as I mentioned? And ask questions that need to be asked, that you can see situations of what am I missing? And I think that is a skill set that people are going to find is increasingly important. And you also have the skill set that says, I'm going to have 3 careers. What do I need to know to have 3 careers over my professional span?
That's Blair Effron of Centerview Partners. Coming up, we go to Davos, where Afsaneh Beschloss of RockCreek will bring us up to speed on two central topics, China and the future of ESG investing.
Most people, including myself, and people who've been in the world of impact investing, do not necessarily like the word ESG.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. A good part of global Wall Street gathered for the World Economic Forum meetings in Davos this week, and a good part of the discussion returned to topics we've discussed here before, China and climate. Afsaneh Beschloss, founder and CEO of RockCreek, joins us now, fresh back from the Swiss Alps. So, Afsaneh, welcome. It's good to have you back in this country. Tell us what came out of Davos, and start with China for a moment, because we did have the Prime Minister Li go over. He was very proud of 5% GDP. Some people are questioning some of those numbers. What was the discussion at Davos about China and where it stands?
So, David, the number is 5.2. Obviously, it looked a little better than what the estimates had been. But as you said, the numbers are less credible these days. I think the general sense that is coming up from China is very simple. Obviously, you had the biggest delegation, I think maybe ever, from China, certainly bigger than the US delegation this year. But while the language was about we're open for business, in practice, as we know, markets were down 23%, outflows, huge outflows last year. Markets are down 10% already in China this year. And if you look at both the economic and the social problems that China is facing, things are only unfortunately getting worse. Because if we look, for those of us who've been long-term investors in China, if you look over 20 years, the first 10 years of that 20-year period, China did fairly well. The last 10 years in China, if you were just a regular investor in their equity markets, you maybe made 1% or 2%. So when you look at that and you look at the numbers of youth unemployment, those numbers also, by the way, came out. They used to show a 20-some% youth unemployment number. They stopped putting that number out, and they started a new index, which shows 14.1, but it excludes college students. Those numbers are showing that student aspirations and young people's aspirations right now in China, those between like 16 to 24, have diminished. China was a country where in the last 20 years, there was a lot of hope. So people thought they would do better than their parents. They thought by getting a better education, et cetera, more job opportunities, they would do better. Those aspirations, unfortunately, are getting squashed for the younger population, and then for the urban, sort of established, mature population, the value of the real estate has come down. So if we look at the next 10 years, while the delegations, whether it's this week or a lot of Chinese delegations are going all over the world right now, trying to woo investors as we speak, it's hard to be convincing. Of course, valuations are low, but what is the trigger to get them up?
Well, what about something you just referred to? Because Prime Minister Li and others within the administration in China have been saying we're going to be pro-business. We're going to be pro-business. Do we have any sense of actually delivering on that promise? Because as you suggest, Afsaneh, they've got a big problem with foreign direct investment, which has gone negative, for goodness sakes.
I think they are saying they're pro-investments. At the same time, the actions over the last year, especially, were maybe less friendly just to investors in general. A lot of the money that went even into their own local markets was going to the SOEs versus their own private markets. The power of the central bank was getting diminished. So while they're making those statements, in practice, unfortunately, they are being less business friendly because there's less money is going into their own private sector, and the fact that central bank is getting more and more directives from the central government.
Jamie Dimon, the head of JP Morgan, while at Davos, says that basically the risk reward has changed dramatically for China. Do you agree with that?
Completely. But also, I just want to say, even though the risk reward was good the last 10 years, China did really well. I'm not sure if investors made as much money. Venture investors made a ton of money early on, but for the companies that are not sold, it's not clear that they would be able to get out of those positions right now. So I think Jamie is very correct in saying the next few years, a lot would have to change in China in terms of economic policies to make it more interesting to investors, both private and public investors.
That's economic policy, which is something that the administration in China can do something about. What about demographics? Because we also got numbers out for demographics, which we're not encouraging.
Exactly. And I think the population keeps on getting smaller. And if you have a population that is diminishing in terms of, because of the previous policies in terms of children that they had, even though that policy has changed, the issue is that together with the aspiration of young people and the fact that there's this youth unemployment really does not bode very well. And the fact that a lot of Chinese investments of households was in real estate, and we know that that sector is hugely down, and even policies are not going to fix that. And last but not least, a lot of the young people have been getting trained to go into services jobs that are diminishing also. So all of that, the demographics, but also the composition of the job market that is changing, again, is not very positive.
Afsaneh, one aspect of the Chinese economy that reportedly is strong and growing has to do with renewable energy, whether it's electric vehicles, whether it's solar panels or whatever. What was the discussion at Davos about what used to be called ESG? ESG's sort of got a bad name now. Larry Fink says he doesn't want to say that anymore. But whatever you call about it, climate-related investment, what was the discussion?
So I think broadly speaking, I think World Economic Forum has been doing a number of studies also over the last year on the ESG topic, and most people, including myself, and people who've been in the world of impact investing, do not necessarily like the word ESG. There is a political issue going on with ESG and DEI. Putting that aside for a second, just basically, I don't think there's a lot of disagreement that there are issues with and risks with climate-related issues. Plus, the economics of solar and wind have changed hugely. And today, they are very economic in many parts of the world, whether it's US, whether it's Africa, whether it's Norway, whether it is the rest of Europe. What we're seeing is that there is China itself, where you're seeing that that whether it is EV cars or it's solar panels, they're going to be a cheaper alternative than relying on oil and gas. So the decisions are economic. I think the Chinese obviously are looking at their own climate-related issues, the quality of air, the quality of water, the quality of food that is coming out and is sometimes hazardous. And they are investing a lot in those areas. Plus, that is the one bright spot, I would say, in China.
Well, and Afsaneh, as you know so well in life and in business, what you call something really matters. And go away from ESG or even climate. Talk about infrastructure. Last week, we had this big deal announced with BlackRock and GIP, Bioequivalence, you know well, as well as Larry Fink. And yes, talking to them about the opportunity they see there in infrastructure, an awful lot of it seems to go back to climate and the investment we need to make to get to net zero.
Exactly. And I think while you will see that Larry may not be using those terms and politically very, very careful on the terminology he's using, you can see what he's investing in. And I think that is a really positive sign in the sense that infrastructure is getting built. GIP obviously is one of the biggest investors in this area. I think, as one of my colleagues, one of the ex-World Bank presidents also is been there as well. And what you see is that that a lot of their portfolio is increasingly investing in energy transition, in bringing power lines and grid expansion of power grids. It's looking at ports and looking at infrastructure with ESG lens. And it's not just GIP, it's not just BlackRock. If you look at Prologis, if you look at really any large company investing in infrastructure or logistics, looking at two areas. One is clean energy and energy transition in order to reduce costs and increase reliability and reduce risks, and also AI, obviously. And those are getting more and more intertwined, and the interrelationship between AI and clean energy, I think, will be an interesting area to watch.
Afsaneh, thank you so much. Always great to have you on Wall Street Week. That is Afsaneh Beschloss of RockCreek. Coming up, we'll wrap up the week in Davos with Bloomberg Senior Executive Editor for Economics and Government, Stephanie Flanders. That's next on Wall Street Week on Bloomberg. Our one more thought this week comes from Davos and from Bloomberg Senior Executive Editor for Economics and Government, Stephanie Flanders.
Many people will have come to Davos expecting to focus on geopolitics, or what the Harvard professor Michael Sandel called here the return of the political. You've got all those many elections coming down the track that we often talk about. You have the return of war, hot conflicts in Ukraine, in the Middle East and the Red Sea. And of course, on the eve of the meetings, you had the Taiwanese election, reminding everyone that China's situation and its relations with the US much more fractious than it had been in past years. In fact, a CEO said to me very early on in the forum, said, I've come here primarily to find out how my peers are solving for the possibility that we might be walking into a World War III. But it didn't really turn out that way. There was a lot of hand-wringing, not just about the possibility of Donald Trump, but absolutely about the fragmentation of the global economy, what that might mean for inflation, the downsides for Europe and the US. But then when you look around here, of course, there's many, many participants from around the world and increasingly from emerging market economies. And you couldn't help noticing that for many of them, fragmenting world, a world that's decoupling from China perhaps, or wanting at least to have more diversified supply chains, was actually serving them pretty well. You can always tell what the fashionable topic is because it's on all the hoardings and all the names on the streets as you walk down the stalls. As you know, David, you have these people set up stalls, companies in different buildings in Davos, and everybody wanted to tie themselves to AI. Even the previously fashionable climate crowd, you could see them wanting to attach their exciting climate plans and events, even more exciting things to do with AI. But there was a change of tone, because we've obviously been talking about machine learning, we've been talking about generative artificial intelligence, for a little while here at Davos. But in the past, we've sort of felt like we knew what they were, and then the thing that we were thinking about was what was going to be the impact on the world and what are the risks that we should worry about. Obviously, we're still worried about risks, we're still worried about the impact. But what's really striking when you go to these demonstrations here, you talk to the experts in the field here, is just how amazed they are and rather confused they are by the sheer pace of improvement in these models. It's almost like they don't understand, well, it is as if they don't understand why these models work as well as they do. That's pretty disconcerting for people here. And I think it kind of added to a feeling, whether it's AI, climate, populism, war, there's an uneasy sense that the global economy is going to be driven over the next few years by forces that, Davos man and women maybe don't even understand, let alone control.
Many thanks to Bloomberg's Stephanie Flanders. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.